Hey there, it is John Downs here, and in this week's real estate and mortgage report, it's April 22nd. I will say I am glad that we are on a new week because last week was kind of insane. We had the possible Iran-Israel situation kind of overnight. Everyone thought, oh boy, it's escalating. Markets sold off in a big way. We had interest rates kind of take this next big move higher. I'll show you that in a second. And a lot of times when all of that happens, it can shatter confidence. It can shatter confidence in consumers. It can shatter confidence in housing. So I was really curious to see how is the energy as we roll into this new week. The spring market's kicking in gear. This is usually the time of year we're going to see a pick up in inventory. But at the same time, we have an uptick in rates and volatility in the stock market. So let's dive into markets. First, I want to show you this 10-year chart. I will always use the 10-year bond as sort of the proxy of where mortgage rates are going. Remember, it's more the direction of the move more than the actual interest rate itself. But here you can see the channel late last year or middle of last year in the summer when rates bottomed in June, July. It was 3.75 on the 10-year. We shot all the way up to 5% all the way through till mid-October. And then right around mid-October, we had a nosedive all the way back down to end the year to 3.75. That was when the market was pricing the Fed dropping rates 6 times. The Fed never said that. That was the market saying that. As we rounded into the new year, we had really strong economic data, retail sales, unemployment, jobless claims, manufacturing. Like there's weakness in a lot of reports, but there's strength also. So the market has been focusing on the weak components. And then I think recently they've started looking at the strong components like, oh my gosh, like maybe things are actually hotter than we think. And the Fed's going to have to be more stubborn and keep rates more elevated, or maybe they won't cut as much. So we started seeing all those Fed cuts being unwound. And even last week, we had Fed speakers coming out saying, hey, we're not really going to be in a rush. We are data dependent. One Fed speaker even said we might have to increase rates if we're not seeing improvement on inflation. So that wound up sending interest rates higher right here. You see this is an average of mortgage rates from Mortgage News Daily. And you'll see here at April 10th, 11th, we were at 7%, and then we jumped all the way up to 7.5% in a week. Now, that was a combination of inflation reports that are not friendly, Fed speakers that were not friendly, and that was also at a time when the stock market, so this is the S&P 500, wound up right there, April 11th, wound up pushing lower and dropping about 3 to 5% in a very short period of time. The NASDAQ, that one dropped about 7.5%. We went from, 16,500 to 15,300. So about 7% drop right there. And if you think about home buyers for a second, a lot of times they're buying because they're feeling like they can. Their assets are going up, their income is going up, life feels stable. So you start talking to mortgage lenders, you get your pre-approval, you start running quotes, you look at houses, you write a contract or two and you maybe lose. And now all of a sudden you're going to reach out to your loan officer on this new weekend and you get interest rates that are 0.5% higher. And then you looked at your portfolio just to check in. You're like, oh my God, that's down 30 grand or whatever, right? It's all percentages based on how much you have. You kind of start putting all those pieces together. It can cause people to be a little paralyzed, almost pull back a little bit. So I had a post last week where I said, hey, sellers, it's actually not the absolute rate. When people are looking at it like, oh, we've been at 7.5% before, it's no big deal. But sometimes it is the rate of change. It is the shock of like, oh my gosh, that just got bigger again. So if you were getting quotes at 6.5 in January, early February, when it went up to 7, you're like, oh, okay, no big deal. My stock portfolio is still doing good. I just got a raise, or I know I'm getting a raise this year. Like everything still felt okay. But from 7 to 7.5, when your stock portfolio just got beat up, that actually might shatter you a little. You might just hesitate. Now, fortunately, we're starting the week and the market is pulling up. So this is last week, right? We fell all the way down and now we're trying to rally back. So I'm curious to see, does the stock market, is this a convincing rally? I think there was a headline that came out that Iran said they weren't going to escalate. Is that going to be enough? Is the market going to try to trade with some optimism here? Or are we just going to wait all the way until this Friday inflation report for the market to decide, are rates going to go up even higher? Is the Fed going to be stubborn? Or are we just going to rally? Is this the peak? Have rates topped out for this part of the cycle? If you go back and you look at this chart, I mean, we did kind of hit that top part of the channel, and maybe we do get this rally lower. Maybe we get down to the bottom part of the channel before we have something else that either confirms that rates are going to stay high, or it confirms a reversal similar to what we had in October. All right, so that's enough about markets. So rates went up, stock market went down. We are flat to slightly improving to start the week on both the stock market and equities, as well as mortgage bonds. So hopefully the damage last week starts calming down. We'll just have to see how this week unfolds. Now, the next part is housing inventory. So you're going to start reading in headlines that are talking about inventory explosion. Like, oh my gosh, inventory is off the charts. Watch out. Prices might come under pressure. Now, I want you to know, like everything, national headlines and national economics, like I really believe it doesn't have a role into micro areas. There is a reason they say in real estate location, 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 and that's because every area is just very different. You know, if you think of having a supply and demand imbalance, you're going to have some areas that have a whole bunch of supply, but no one wants to live there for whatever reason, right? So then the fact that they have too much inventory, it could be rental inventory, it could be homes for sale. If they have a lot of it, prices will absolutely come down. They will. It's just how it works. But the opposite is also true. If you have no inventory, but yet enough demand to still satisfy that inventory, you can still have a very stable market, even in the face of high interest rates. In the DC metro area, it is very heavy in government spending, defense spending. If you think of the bill we just passed again this weekend, likely to go through the Senate and have the president sign off, I'm pretty sure some of that money flows through into our local economy. So one could argue that a lot of the national headlines that you see, that while it might hit us eventually, it probably hits us last, and it is likely very muted. So I just want to call out the difference between national data and local data. So speaking of that, I want you to look at this. I'm going to link this below. It's from the Resi Club, Lance Lambert. He sort of aggregates a bunch of data. So this is one area, San Antonio, Texas. Right now, end of March, they had 9,500 units for sale of housing. And during the pandemic, it was a hot market. Prices actually, were pretty well juiced right there. But you see, before pandemic, they were between 7,000 and 8,000. So they are already experiencing a heightened level of inventory. So one could assume that their prices might be under pressure, or maybe that the sellers there, when they sell, begin offering incentives. If anyone's in that market, please comment below. I'm curious what you're seeing on the ground. Now, if I shift over here to my market, one of them, Baltimore, you'll see we only have 3,400 units, where pre-pandemic we had 8,000 to 9,000. Right? It's insane. And then if we pull in the Washington, D.C. metro area, same thing, 6,300 units compared to in the teens of thousands, right? 12,000, 13,000, 14,000. A lot of the inventory challenges, you should then look local and say, why is that? Why is there more inventory in some areas and prices under pressure, whereas others aren't? So it is local economy, jobs, the how high paid are the jobs in your local market, new construction, how much new construction is there? Is there the ability to build a lot of new construction? In DC Metro, the answer is mostly no. So there's not a lot of areas to build new construction. It is a lot of tear down, rebuilds, a lot of small flippers that are taking old inventory and turning it into new. But you also have an influx of people. You had household formations increase. So the world where two young people would have roommates, I think our market became a lot of individual people living solo. I think COVID, pandemic, work from home, I think a lot of that had something to do with it, and that sort of stuck. But I want to dig into the local data from Altos Research. Altos is a company that sort of scrapes the MLS, where Lance Lambert will use kind of end of month data. Altos refreshes every week, but they do use averages. I like using the 7-day average. They also have a 90-day average. And I want to show you the DC metro area, Baltimore metro area. It says essentially what Lance's report shows, which is not a lot of inventory. But then I want to get a little specific to an area that actually has an increase in inventory. And people on the ground will understand this. And this is where having a really good real estate agent on your side that understands the market inside and out, because you can find these little micro areas where the story is completely different than maybe something 5 to 10 miles away. Now, in this week's Altos report for Washington, D.C., you'll see it's still the market action continues to go up, favoring sellers. A big part of that is still very low inventory. This is the single family home report. I am excluding condos and co-ops just to keep things pretty quick. But all these links will be below. You can click the little condo tab right there at any point, dive deeper into the numbers, hit that little toggle switch, kind of look at whatever you need to look at. But again, 3,750 single family units pre-pandemic, we had about 9,500. So obviously a lot less. The new new listings compared to newly absorbed. So houses under contract, kind of balanced, nothing I see there that is unrealistic or kind of showing one big powerful story over the other. You will see price decreases going up slightly. Now, just remember when you see things, you always have to go to the historical chart to see how seasonal behaviors work. This is the time of year we start seeing prices decrease. But it's also the time of year we are likely to see more inventory hit. So when people say inventory is rising, well, it should. Seasonally, it always has. In 2022, it was more pronounced over the last few years. That was the initial interest rate shock. Oh my gosh, like what is going on? Rates are rising, stocks are falling, I'm feeling less wealthy, and everything's getting way more expensive. I don't know if I want to buy, right? So inventory picks up. And then, of course, as we rolled into the following year, late 22 into 23, rates rallied a little bit, raises popped up, confidence came into the market, everyone started the date the rate tune, and the market rebalanced. And then we never had any of that big inventory in 2023. I think you can always watch the video. I'll maybe link it in the description below. Like, where did all the inventory go? And it really speaks to everything in that video. Will kind of highlight what's going on here. Now, if we go into Montgomery County, Maryland, same thing. I just want to highlight, so 359 and pre-pandemic, we had 1440. Fairfax is the same way. So all the counties surrounding DC wound up seeing really, really low inventory. But here's what's interesting. If you get into DC, you will actually see an increase of inventory. So on average, 7-day average, 1,000 units. And then pre-pandemic, we were down at 400, less than 400, 370. Now, if you dig deeper into these numbers, you will find very different stories all throughout Washington, D.C. And there's a whole bunch of different conversations you can have on this, right? One could be work from home. Some people are just pointing to the different lifestyles of people. So young families sort of want suburban living now instead of city living. And therefore, a while, I think we had this 10-year generational block in D.C. where you had the grandparents that wanted to move to the city to have close healthcare, walkable lifestyles, be close to their grandkids. You had young professionals willing to raise their families and get their kids at least through like 3rd, 4th grade before they would think of private school or different charter schools or areas or then move to the burbs. And now I'm seeing that young people thinking of having kids are thinking burbs right away instead of have your kid wait till they get 8 years old and move, and then the grandparents aren't coming here. So I think there is a movement that has changed from the pandemic, how people, where they go to work, how business is done, where they go to hang out, where they want their kids to go to school. And then the question is, how does that unwind? Does it? What do the next 2, 3, 4 years look like? Does work from home unwind, bring people back? Does the fact that the suburbs are so expensive and DC is now becoming affordable, is that going to be a catalyst? Does crime get the voice everybody wants it to have? Does the Caps and the Wizards and the big renovation that's going to happen there, does that transcend energy that wants everybody back and sort of invigorates the younger lifestyle of young professionals? The other thing to know is that if you get into different sections of DC, you find that it's insanely hot and crazy competitive. Most all of Northwest is crazy, but that area lives more like the suburbs than maybe Northeast. So the key is have a really good agent on your side. Don't get sleepy on the data. Don't let the things you read sort of sway you one way or another, because you could read something and hear even what I said right there and be like, oh, I wouldn't buy in DC. And oh, I can go in and go under list and ask the seller to pay all my closing costs and whatever. But depending on the area that you're looking in and how it's priced, the answer is like maybe no, you can't do that. But in maybe some other areas, yes, you can. Or maybe if you need a seller to pay all your closing, maybe that's like, okay, I need to go in those areas where maybe inventory is up, where houses are on the market for more than 21 days, maybe what hasn't had a price reduction yet. So there are keys to look for if the idea is a certain structure, a certain buy my rate down or pay my closing costs, or, looking for maybe a certain amount of cash flow, maybe from renting to roommate. So anyway, if you have any of those questions, drop them below. Love to chat about this and more. I'm a big DC. I love DC. I want DC to thrive. I do believe that's where the most opportunity in real estate in our local market is right now from a 5-10 year property appreciation standpoint, but curious to get your thoughts. Okay, let's land the plane here. Looking at a Baltimore market, it's kind of, when I say boring, it's really just a lot of the same story. It's kind of everything I wound up showing you with the DC MSA in Montgomery County, only 1,600 units for sale pre-pandemic, 5,000. Anne Arundel is sort of a big bedroom community now for both DC and the Baltimore city markets. And it's just feels like it's never been worse. Only 294 listings on average at the bottom of the bottom, like the worst inventory's ever been at the height of the market. 291 was the low. And we're lower than that. Actually, we're tied for that. But pre-pandemic, 1,600. Like, just to think that we have 80% less inventory, it just fascinates me. So that's it for this week's update. I hope you've enjoyed it. If you have any questions, you can always let me know. Be sure to subscribe to the channel. I'm going to do these every week. And again, if you have any topics you want me to cover in coming updates, please just drop them below, and can't wait to see you next week.